Hello and welcome. My name is Riker Dean. Today's date is February 2026, and we need to talk about something nobody in Washington wants to admit. The American consumer is breaking. Not Wall Street, not the Dow at 50,000, not the NASDAQ at record highs. Main Street. And the gap between those two worlds has never been wider. You keep hearing about strong payrolls. You keep hearing inflation has come down. You keep hearing that this is a Goldilocks economy. Perfect growth, perfect wages, perfect markets. But 87% of Americans say we're in a cost of living crisis. More than half of U.S. households struggle to pay monthly bills. That's not Goldilocks, that's structural stress. Grocery prices are up roughly 30% in 5 years. Housing costs have surged nearly 60% in 6 years. Electronics, tariffs stacked on top of supply chain disruptions. Utilities rising, insurance rising, healthcare rising. The Dow at 50,000 does not pay your rent. This is not an asset bubble problem. This is an affordability crisis, and the administration knows it. That's why the narrative is being controlled so tightly. When stock indices are breaking records, it creates psychological cover. It creates the illusion of strength. It allows policymakers to say everything is fine while households quietly drown. But here's the structural issue. This isn't temporary inflation. This is embedded cost escalation. Tariffs didn't just protect American industry. They raised input costs across the entire ecosystem. Even companies sourcing domestically are affected because the supply chain is interconnected. Higher transport costs, higher component costs, higher financing costs. You can't isolate the U.S. economy from the world without raising prices. Meanwhile, China has spent 2 decades increasing manufacturing productivity. State subsidies, lower labor costs, industrial policy focused on output, not stock buybacks. The U.S. leaned into financialization and tech dominance. Wall Street thrived. Manufacturing hollowed out. Now that gap is structural. Consumers are paying for that gap. Here's the dangerous part. Government spending is already near $7 trillion annually, nearly a quarter of GDP. If consumer weakness accelerates, Washington has only one playbook: spend more. More deficits, more bond issuance, more debt. And that brings us to the real pressure point: interest rates. The U.S. is sitting near $39 trillion in national debt. If long-term yields stay elevated, interest payments alone begin crowding out productive spending. You either let rates stay high and risk recession, or you suppress rates and risk inflation. There is no painless option. Some suggest shifting issuance to short-term treasury bills to keep borrowing costs lower. But that is functionally money supply expansion. That invites currency weakness and inflation expectations. So policymakers are trapped between higher rates that squeeze consumers and monetary expansion that squeezes purchasing power. Meanwhile, essential services are consuming a larger share of income: housing, healthcare, utilities, education. These sectors have pricing power because demand is non-optional. You can skip a vacation, you cannot skip rent. Wages are rising in select sectors, but the composition matters. Tech compensation and specialized labor push wage expectations higher in essential services. Healthcare systems must pay more to compete. Utilities must upgrade infrastructure. Data centers consume massive power and water resources, pushing grid costs higher for everyone else. AI infrastructure is not free. And that leads us to the next stress layer. The AI boom was positioned as America's economic savior, the ultimate competitive edge versus China, the reason to justify massive capital expenditure. But hyperscalers, Microsoft, Meta, Oracle, Nvidia, have been issuing record amounts of corporate debt to fund data center expansion. Over $120 billion in bond issuance from the top 5 alone last year. Total corporate issuance approaching $2.5 trillion. That is capital competition. When corporations flood the bond market, they compete with the U.S. Treasury for investor dollars. Yields rise, liquidity tightens, financing costs climb. Now markets are wobbling. Credit default swap demand on major tech firms has jumped sharply. Investors are hedging downside risk. Insurance against default is getting more expensive. The narrative is shifting from infinite AI growth to who is paying for this? And now Washington is signaling something even more disruptive. Hyperscalers may be required to internalize infrastructure costs. No federal backstop, no blank check subsidies, no taxpayer underwriting of data center expansion. Instead, tech firms may have to fund grid upgrades, water usage compensation, and local infrastructure support themselves. On paper, that sounds responsible. In markets, that is margin compression. Data center power demand could double by 2030, from under 200 terawatt-hours to over 400. That implies massive capital investment in energy generation and grid expansion. If tech firms must absorb those costs directly, operating cash flow declines. Balance sheet strain increases. Bond issuance grows. Investor risk perception rises. And if the music slows in AI capex, what happens to the narrative that has held the market up? This is where the system becomes fragile. You have a squeezed consumer, a debt-heavy federal government, a corporate bond tsunami, an AI bubble facing capital limits, and a political cycle approaching midterms. The administration must appear strong, markets must appear stable, but underneath, liquidity is tightening. The affordability crisis is real, and it's not solved by a record Dow. Now let's go deeper, because what we're seeing isn't just economic strain, it's structural distortion. The stock market is still levitating because capital has nowhere else to go. That's the uncomfortable truth. For more than a decade, liquidity flooded the global system. Post-2008 stimulus, post-2020 stimulus on steroids. Trillions created, deployed, recycled. Corporate balance sheets were repaired, asset prices inflated, and global investors learned one lesson: the Fed will backstop risk. That belief created what traders call the Fed put. If markets fall hard enough, liquidity appears. Rates get cut, conditions ease, risk assets recover. But here's the shift nobody wants to acknowledge. Inflation limits the Fed's flexibility. If inflation is structurally embedded, and shelter, insurance, healthcare, utilities suggest it is, then aggressive rate cuts risk reigniting price pressure. That means the safety net beneath equities is thinner than investors assume. At the same time, consumer balance sheets are deteriorating. Credit card debt at record highs, delinquencies rising, households allocating larger portions of income to non-discretionary expenses. That reduces discretionary consumption, the engine of 70% of US GDP. When discretionary spending weakens, earnings growth slows. When earnings slow but valuations remain stretched, volatility increases. And volatility is already creeping in. We're seeing larger intraday swings in equities. We're seeing defensive rotation. We're seeing capital move from high-growth narratives into cash flow stability. That is not panic yet, but it is positioning. The AI trade is the center of gravity. Hyperscalers are committing hundreds of billions into infrastructure. Investors were comfortable funding it when growth felt exponential and liquidity abundant. But when yields rise and federal deficits expand, that capital becomes more expensive. And here's the tension. Government deficits require continued treasury issuance. Corporate bond waves require investor absorption. There is only so much global demand for U.S. paper at current yields. If yields rise further, mortgage rates stay elevated. Housing affordability worsens. Refinancing dries up. Consumer stress deepens. If yields fall because growth slows, recession risk rises. There is no clean equilibrium. Meanwhile, geopolitics adds fuel. Tariffs remain a structural tax on consumption. They are politically marketed as strategic tools, but economically they function as price increases. Supply chains have not magically reshored at scale. The cost base is higher. And let's be clear, tariff revenue does not directly lower grocery bills. It flows into federal accounts, servicing debt, funding defense, financing operations. It does not reduce the cost of eggs. The consumer is effectively underwriting fiscal policy. Now layer in the demographic reality. An aging population increases healthcare demand. That drives employment in that sector, which is why healthcare payrolls keep rising. But healthcare expansion does not generate productivity gains the way manufacturing or technology scale does. It maintains existing quality of life. It doesn't necessarily expand output. So headline job growth can look solid, while underlying economic dynamism slows. Construction growth? Largely data centers and infrastructure tied to AI. These are capital-intensive, specialized projects. They do not create broad-based employment multipliers the way housing booms once did. We are building server farms, not suburbs. And server farms require energy, massive energy. Power demand projections show steep increases over the next decade. If grid upgrades lag, costs rise. If tech firms are required to internalize these upgrades, margins compress. If margins compress, valuations adjust. Markets are forward-looking. They don't wait for earnings to collapse. They price risk early. That's why you're seeing CDS markets expand around major tech names. That's why volatility is picking up. That's why capital is becoming more selective. Now here's the uncomfortable macro endgame scenario. If consumer weakness intensifies, Washington may respond with fiscal expansion. That supports GDP numbers temporarily, but increases debt issuance. Higher issuance pressures yields. Higher yields pressure consumers and corporations. That feedback loop accelerates. Alternatively, if policymakers pivot to monetary easing to relieve debt stress, the dollar weakens and inflation expectations rise again. Purchasing power erodes further. Either path stresses households. And politically, that's combustible. Midterms approach. Narratives will sharpen. Economic messaging will intensify. But messaging cannot override math. A 60% rise in housing over 6 years doesn't disappear because the S&P prints new highs. A 30% increase in grocery costs doesn't normalize because unemployment is 4.3%. Affordability drives sentiment. Sentiment drives political outcomes. Now let's address the final layer, capital psychology. For years, investors believed the U.S. market was the only game in town. Deep liquidity, strong corporate governance, technological leadership. But foreign indices have started outperforming at times. Capital rotation is global. If U.S. valuations stretch too far relative to growth, money reallocates. And if foreign central banks continue diversifying reserves, dollar demand softens at the margin. This isn't collapse talk. It's cycle talk. Every expansion reaches capital saturation. Every bubble tests liquidity limits. Every debt cycle confronts refinancing reality. The AI revolution may be transformative long-term, but in the short term, financing it at scale in a high-debt, high-yield environment creates strain. The consumer can't carry the system alone. The government can't borrow infinitely without consequence. Corporations can't issue unlimited bonds without yield impact. Something adjusts. Maybe it's valuations, maybe it's spending, maybe it's inflation, maybe it's growth. But adjustment is inevitable. The biggest mistake right now is assuming record indices equal economic strength. They don't. They reflect liquidity concentration. The real question isn't whether markets can keep rising in the short term. They can. Liquidity can distort reality for long stretches. The real question is whether the underlying foundation, consumer affordability, debt sustainability, capital allocation discipline, is strengthening or weakening. Right now, the data says weakening. And if that continues into 2026, volatility will not be a surprise. It will be a consequence. This is not fear-mongering. It's arithmetic. And arithmetic always wins in the end. Stay sharp.